Welcome to the Ellsworth Advisors monthly update for November. I'm Kelly Keenan, this is Cameron Mealy, and today we will talk about the latest economic data, how the accounts and how our portfolios have performed through the month, and also our thoughts on what to expect going into the end of the year. Cam, why don't you kick us off with some economic data?
Perfect, thank you, Kelly. Good afternoon, everybody. Since we spoke last in October, really had three big pieces of economic news come out, economic data come out. That'd be GDP, employment, and Fed decision on interest rates. Let's look at GDP. This was, for anybody who's been watching, this number was expected to be big. It came in big. It was a bit of a shock, just given the trends we've seen in the economy. But on October 26th, the Bureau of Economic Analysis announced that according to its advanced estimate for third quarter GDP, the annualized growth rate came in at 4.9%. Now you will remember the target rate for a mature economy like the U.S. is 2%. So 4.9% is obviously a significant number. It comes after an increase of 2.1% in the second quarter. So right there, that tells you, wow, U.S. economy really moving forward, full steam ahead. But then we had the employment numbers. On November 3rd, the Bureau of Labor Statistics reported that total non-farm payrolls in October increased 150,000. This was less than the estimate of 170,000 and sharply lower than the 297,000 growth rate in September. So we've seen employment now cool down a little bit. The unemployment rate unexpectedly increased to 3.9%. So, basically we're in a situation where we've seen the Fed aggressively raise interest rates over the last 2 years. The economy has continued to perform. Inflation has continued to be very strong, worrisome strong. Employment, has now, we've seen the first kind of chink in the armor in terms of employment. So this really gave the Fed reason for pause, and this is a reason that we've seen a lot of new enthusiasm in the market. The Fed did meet on October 31st through November 1st, and on the 1st, they announced that they were holding their federal funds target rate at 5.25% to 5.5%. This was their second pause since they really began their rate increases in March of 2022. This is an article from Forbes, and this is pretty telling. This was a November 2nd article from Forbes. Fixed income futures markets currently see a 1 in 4 chance that rates move higher at one of the Fed's next two decisions on December 13th or January 31st, according to the Chicago Mercantile Exchange's FedWatch tool. The market's base case is that we're now at peak rates and we will move later into 2024. Rate cuts become more likely than rate hikes on current estimates. Yet Fed Chairman Powell was clear in his post-meeting press conference that the committee is not thinking about rate cuts at all. So, unfortunately for the Fed, their real goal is to try to balance proper inflation with proper economic growth. And when those two get out of whack, one hurts the other. Inflation's too high, you're going to drive down economic activity because borrowing rates become so expensive. And we're seeing that right now. I think this Fed pause is a wise decision. Just like I said after the last one, we've seen historical growth, almost 500 basis points in interest rate increases over the last 2 years. That is aggressive by any historical measures. I think the Fed is finally seeing the writing on the wall that really the consumer, the economy, business owners are just asking, let's take a pause, let's step back, let's see how this is playing out, because we're now are seeing it in slowing labor market. We're also seeing it now in fourth quarter GDP estimates. While the third quarter was a blowout, it does seem to be an anomaly. According to our often quoted Atlanta Federal Reserve GDP Now forecast model, as of November 1st, the targeted fourth quarter annualized increase in GDP is down to 1.2%, which really now falls more on the anemic side of economic growth. So taking this all together, I think the Fed has now said we need to stop, we need to wait, we think we're doing the right thing. We've seen inflation come down, we're seeing employment slow, we're seeing projected GDP to come down. Hopefully we didn't go too far. Let's see how this plays out. Let's take a breath. Let's get into 2024.
Yes, that is exactly what's going on.
It's actually been very good for the stock market over the last week.
Well, yeah, the last week we had a nice bounce. It's typical. You have a big GDP quarter. The next one, it'll get lower again. The reality is with the rate hikes, that is to slow down the economy. The reality when the Fed raises interest rates is definitely a lag effect, and we're starting to see the lag effects. In the employment realm, little softer employment numbers. The reality is one of the statistics is actually there's more people entering the labor force. So the numbers for employment are still pretty good, but they're definitely softening. They're softening in consumer spending. So there's definitely signs, I think, as we get into the holiday season that'll really give us an idea what's going on with the consumer. Are we falling off a cliff? I wouldn't call, going from 4.9 to 1.2 falling off a cliff. 1.2 is kind of a normal number for, through much of the Obama administration. So that's not unusual in the low interest rate environment. But then again, we are probably seeing, some softening, which says the Fed should probably take a break and kind of see how things shake out.
It's looking like the Fed and Fed Chairman Powell, historically, looking back years from now, might actually get this right. It looks like it doesn't look like we're trending towards a recession. It does look like we're trending towards a slowdown, a soft landing as people call it, and hopefully we reset and in 2024 can start moving to higher economic numbers and better stock market performance.
Yeah, and I don't rule out a soft landing at all. The economy got warped through COVID with different businesses feeling the effects differently. I think the consumer is definitely in better shape now than, say, 08, 09. So if we do have a recession, as I said before, it's probably not going to be, a horrible recession, especially for clients or for consumers. That's kind of what the expectation is if we end up getting into that situation. We did see a nice bounce last week in the stock market. The last week of October, the markets hit basic correction phase, being down 10% from the recent highs. So, kind of back into correction. But then the last 3 days of last week, basically all those losses or all the downside in October was wiped out in a few days. The market was way oversold. Fed comes in, talking about taking a pause with interest rate hikes. The market just definitely jumped on that to take advantage of the oversold condition. We had a nice bounce. We did see interest rates drop. On the longer end, the 10-year Treasury had gotten over 5% within the last 2 weeks. Now it's back down to 4.6. There is some talk around that in that the Treasury, instead of issuing longer-term bonds, so instead of creating more supply of longer-term bonds, which would have kept rates high, they shifted their new bonds to short-term T-bills, which really didn't move that market because there's a lot of liquidity there. A lot of people are putting money in the short-term T-bill, so we didn't see any movement there, but we did see the longer end come down. So it's hard to say if all these things are a trend or just kind of a
But
blip
isn't
in the
that's
data.
also the Treasury's expectation that interest rates, we have reached a near peak and rates will start coming down. Obviously, you're not going to lock in rates for longer term at what you believe to be a higher rate. You're going to go short-term borrowings so you can, quote unquote, refinance when you issue new treasuries at a lower interest rate.
Right.
So they're signaling the same thing that everybody's talking about.
Treasury hasn't been real good about locking in rates, seeing as they could have locked in at 3% several years ago, trillions of dollars. But so
are you going to call up Janet Yellen and yell at her?
That's not my position. I was not asked to do that. So let's talk about the markets and how our portfolios have performed in the short term and year to date. From an index standpoint, in October, the S&P 500 down 2.2%. The Dow Jones was down 1.36%. The NASDAQ down 2.78%. The Russell 2000, which is small cap stocks, down 6.88%. The international developed world, and as measured by the EAFE, down 4.1%. Emerging markets definitely took it on the chin. Emerging markets held up pretty well, down 3.95%. For the month, year to date, S&P still up 9.23%. Dow Jones down slightly, 0.28%. NASDAQ still up 22.78%. Small cap stocks down 5.62%. International stocks basically flat year to date, up 0.21%. Emerging markets down 4.31%. One thing I did take a look at, we still have not seen, or the markets still have not gotten back to the highs they saw back on December 27th, 2021. And just looking at the S&P 500, right now the S&P 500 is still about 8.87% off of its highs, which on an annualized basis is still down 4.96% annualized. So market still has not fully recovered, and it's felt like we've been in a good market, but the reality, last 2 years, the markets are still a little
Just
bit
clawing back.
They're still underwater.
Well, and frankly, if you look at the NASDAQ being up more than 20, everything else, essentially being down or, flat, it really does show, again, it's these 7 large cap tech company stocks that are all up 60, 80, 100% that have really driven all the performance in the indices, and everything else has just been flat to moderate to even, a little disappointing.
Right, and even the NASDAQ hasn't regained its highs. The reality is the 7 stocks definitely took it on the chin in 2022, so that kind of slowed things down. From a portfolio standpoint, growth with income for the month, down 0.9%. Year to date, still up 3.9%. Big gainers, Raytheon up 13%, Nike up 7.5%. Our gold position up 7.4%. Walmart up 2.2%. Where we saw our laggards for the month, Exxon down 10%. Microchip Technology down 8.7%. NVIDIA giving some back, down 6.3%. Year to date, big gainers though. NVIDIA still up 179% for the year. Apple up 32% for the year. Iron Mountain up 22%, and Lennar up 19.5%. Big laggards for the year, CVS down 23.6%. Johnson & Johnson down 14%. Honeywell down 14%. Even though Nike picked up 7.5%, they're still down 11.4% for the year. From the peak, growth of income, we're only down 2.69%, so definitely has done better than the markets. Dividend yield for October down 2.3%. Year to date, underwater, down about 1.6%. October gainers, Verizon up 10.7%, Waste Management up 7.8%, Southern Co up 4%. Our laggards, Caterpillar down 16.8%, Blackstone down 13%, UPS down 9.4%. Year to date though, Eaton up 34.3%, Blackstone, even though it gave up 13%, still up 29% for the year. Packaging Corp up 23%. In our laggards column, U.S. Bank down 23.7%, Pfizer down 20.5%, and 3M down 20.8%. From its peak, we're down 3.11%, from the peak of the market back in 21. Appreciation with income, in October down 2.9%, year to date down 2%. We had some banks in here, so that's definitely drugged down performance in this portfolio. American Tower up 9.5%, Gilead up 4.8%, Union Pacific up 2%. That was for the month. For the month, Santa Fe down 16%, Watsco down 7%, General Digital down 5.8%. Year to date, big gainer still Dell Technology up 71.3%, Broadcom up 53%, Energy Transfer Partners up 22%. From our laggard standpoint, Bank of America down 18.6%, Public Storage down 12%, and Lamar Advertising down 9.2%. Price potential in October down 2.8%, year to date up 2%. October gainers, Arch Capital up 8.7%, Humana up 7.6%, Via up 2.2%. Laggards for the month, Valmont Industries, which we actually got out of yesterday, down 18%, Columbus McKinnon down 12.4%, Quaker Houghton down 10%. Year to date, still in the portfolio, Intuit up 22.8%, Fiserv up 12.6%, Visa up 13.8%. Laggards still in the portfolio, really only have one laggard that's still in the portfolio, BNY Mellon down 3.3%. Small caps in October down 4%, year to date up down 2.5%. So small caps, they've been definitely the most volatile. We've held up there pretty well. Big gainers in October, Nuvalent up 13.3%, Winmark up 8%, Northeast Bank up 8.3%. Laggards, Schrodinger down 23%, Alpha Metallurgical down 16.7%, Flywire down 15.7%. Big gainers still in the portfolio, Consolidated Water up 102%, Nuvalent up 75%, and Perform Line Products up 63%. The one laggard still in the portfolio, Excel Services down 23%. So that's kind of where we stand. expectation-wise, like I said, we started the month off pretty well. We hope that holds up, but not really holding my breath. I think it's going to be a choppy end of the year. But, historically speaking, November, December tend to be the best months of the year. I can see, forward advancement, even though it's going to be choppy. I do think we're, still higher at the end of the year. I think, just from the natural flows of dollars and the fact that we've come off 3 pretty rough months, we should get some support into the end of the year. Interest rates will be a wild card. The 10-year at 4.6. I don't think the story is fully over with interest rates. I can see us revisiting the 5% again and 10-year. So, it'll be choppy, but I think we're in pretty good shape going into the end of the year. Portfolios have held up well. Since the end of the month, all of our portfolios have rebounded all their losses and then some, just from last Wednesday till today. So, if you have any questions, like to discuss your accounts, please give us a call and let us know.
And as always, thank you very much for your trust. We hope you and your family have a great Thanksgiving, and we'll talk to you again in a month.